Hello traders, welcome back to the channel. In this video, we will be discussing a trading strategy that can help you maximize your profits as a trader. The MACD Stochastic and Parabolic Sar Trading Strategy. We will be exploring the different components of this strategy, including the tools and techniques used, as well as the psychology behind it. We'll also discuss how this strategy can be adapted to fit different trading styles and markets. So stay tuned to find out how you can take your trading to the next level with this powerful strategy. If you want to watch more videos like this, make sure to subscribe, like the video and hit the notification bell so you never miss out on any future uploads. MACD or Moving Average Convergence Divergence Indicator is a technical analysis tool that is used to identify new trends and measure momentum. It's composed of two exponential moving averages that measure the difference between a fast and slow moving average. MACD as a trend-following momentum indicator, it allows you to assess the current trend direction that can be bullish or bearish and predict where the price is more likely to go, based on the relationship between two moving averages. And it allows measure the rate of change of prices, also known as the speed of the trend or its momentum. The MACD momentum readings are useful if, for example, if a trader wants to assess the strength or weakness of trend. MACD relies on the latter, as they provide data that is more relevant for making decisions whether it's worth buying or selling the asset. The MACD indicator is made of three key components. 1. The MACD line. The fastest moving average, it is the short-term exponential moving average. The MACD indicator formula is calculated by extracting a long-term, 26-day exponential moving average from a short-term, 12-day exponential moving average. MACD line is equal 12-day exponential moving average minus 26-day exponential moving average. 2. The signal line. The slowest moving average, it is the long-term exponential moving average. This is a 9-day line designed to show the turns of the price action. Signal line is equal the 9-day exponential moving average of MACD line. 3. The MACD histogram. Fluctuates above and below a zero line, which helps to identify bullish and bearish momentum readings. The histogram is the difference between the first two elements, MACD line minus signal line. When MACD line is above the signal line, the histogram is positive, and when MACD line is below the signal line, the histogram is negative. These three components can help you spot potential buy and sell signals in the following conditions. When MACD is positive, that means the MACD line crossed the signal to the upside, and the histogram is increasing as well. This serves as a sign of increasing momentum. The price tends to grow in this case, which can be interpreted as a buy signal. When MACD is negative, that means the MACD line crossed the signal to the downside, and the histogram is decreasing as well. This serves as a sign of decreasing momentum. The price tends to drop in this case, which can be interpreted as a sell signal. In general, the MACD provides three major types of signals. 1. Signal line crossovers. 2. Zero line crossovers. And 3. Divergence. Let's take a closer look at how you can spot potential buy and sell MACD signals. 1. Signal line crossover. This is the most basic signal that you can take advantage of. The signal line shows the moving average of the MACD line. This is why it always lags behind. The obvious crossovers of these two lines signify potentially strong movements. The position of these lines shows whether a crossover is bullish or bearish. Bullish crossover happens when the short-term exponential moving average crosses above the long-term exponential moving average. Bearish crossover happens when the short-term exponential moving average crosses below the long-term exponential moving average. 2. Zero line crossover. To strengthen the signal further, look out for the general trend. If it corresponds with the crossover, the reliability of this signal will be higher. This signal is similar to the previous one. The difference is that the MACD line crosses the zero level, instead of the signal line. When it turns positive, it signifies a bullish trend. And vice versa, when crossing the zero line in the downwards direction and becoming negative, MACD points to a bearish trend. 3. MACD divergence. The MACD indicator can also be used to identify divergences. A divergence occurs when the MACD line is indicating one trend while the asset's price is indicating another. When a bullish divergence occurs, it is often a sign of an impending uptrend. Conversely, when a bearish divergence occurs, it is often a sign of an impending downtrend. MACD indicator is a useful tool for traders of all levels, from beginners to advanced, but as with any technical analysis tool, it should be used in conjunction with other indicators to confirm entry and exit points, as well as to identify potential support and resistance levels. The Parabolic SAR can help you filter false signals. The Parabolic SAR is a trend-following indicator, meaning it will follow the current trend of the chart. It is displayed as a series of dots and is placed on the chart in relation to the price of the asset. The indicator is also referred to as a stop and reverse system, which is abbreviated as SAR. The indicator is used to identify potential reversals in the price of an asset. It can also be used to provide entry and exit points. The Parabolic SAR mainly works in trending markets. Wilder recommends traders should first establish the direction of the trend using the Parabolic SAR, and then use alternative indicators to measure the strength of the trend. How Parabolic SAR works. The Parabolic SAR is usually represented in the chart of an asset as a set of dots that are placed near the price bars. Generally, when these dots are located above the price, it signals a downward trend and it is deemed to be a sell signal. When the dots move below the price, it shows that the trend of the asset is upward and signals a buy. The change in the direction of the dots produces trade signals which can produce a profit when the price makes big swings. However, the indicator is not as reliable in a flat or ranging market. It can also be used to identify potential support and resistance levels. If the price bounces off the Parabolic SAR, it can indicate that there is strong support or resistance in that area. It may produce false signals when the price moves sideways, and the trader should expect small losses or small profits. That's why the stochastic indicator will help you filter these false signals. The stochastic indicators are technical analysis tools that utilize a momentum oscillator to measure the velocity and magnitude of price movements. They are used to identify possible overbought and oversold conditions in the market and provide signals for potential reversals or continuation of a trend. Stochastic indicators measure the relationship between the closing price of a security and its price range over a given period of time. The oscillator is calculated by subtracting the low of the period from the closing price, and dividing that by the high of the period minus the low of the period. The result is then multiplied by 100 to create the stochastic oscillator. The indicator is composed of two lines, the %K line and the %D line. The %K line is a fast-moving line that is more sensitive to price movements. The %D line is a slower-moving line that is derived from the %K line and is seen as a smoother version of %K. We use the crossover of the two lines to generate signals. When the %K line crosses above the %D line, it is seen as a buy signal. Conversely, when the %K line crosses below the %D line, it is seen as a sell signal. Stochastic indicators are useful for traders as they can provide an indication of a potential reversal or continuation of a trend. They can also be used to identify overbought and oversold conditions in the market. An overbought level is indicated when the stochastic reading is above 80. Readings below 20 indicate oversold conditions in the market. A sell signal is generated when the oscillator reading goes above the 80 level and then returns to readings below 80. Conversely, a buy signal is indicated when the oscillator moves below 20 and then back above 20. Overbought and oversold levels mean that the security's price is near the top or bottom, respectively, of its trading range for the specified time period. Let's now jump to our trading strategy. Trading strategy. For this trading strategy, we are going to use the three indicators we talked previously: MACD, stochastic oscillator, and Parabolic SAR. All of them with the default settings. By rules. For long entry, follow these steps. 1. The MACD lines crosses over the signal line to the upside and the histogram is increasing as well. This serves as a sign of increasing price momentum. 2. The Parabolic SAR has to be below price for long entries. 3. The stochastic oscillator must be above the 50 level or close to this level. 4. Buy after the close of this strong bullish candle. Place your stop loss a few pips below the entry candle or in the previous swing low. Use 1:2 or above risk-reward ratio for your profit, or use the previous swing high as your profit target. Let's see how the market will move. Sell rules. For short entry, follow these steps. 1. The MACD line crosses over the signal line to the downside and the histogram is decreasing as well. This serves as a sign of decreasing price momentum. 2. The Parabolic Sar has to be above price for short entries. 3. The stochastic oscillator must be below the 50 level or close to this level. 4. Sell after the close of this strong bearish candle. Place your stop loss a few pips above the entry candle or in the previous swing high. Use 1 to 2 or above risk-reward ratio for your profit, or use the previous swing low as your profit target. Let's see how the market will behave. We hope you enjoyed this video and found it useful. Make sure to practice and understand the strategy before applying it in real trading. And most importantly, since trading involves risk and can lead to losses, always follow strict risk management rules. By doing this, you will increase your chances of becoming a successful trader. Thanks for watching, and good luck.